what's going on with NATO, which is a big defense ETF?
Yeah, you know, and I trust the market more than I trust headlines, and certainly headline writers. But this is the themes transatlantic defense ETF, NATO, NATO, and it broke below the 200-day yesterday, and it's following through today. So this is the area over here, and this is Raytheon, Boeing, GE. The big primes, if you will, defense contractors. And as you might have expected, it broke out at the beginning of the year when it started to somehow sniff out the war was going to give them a lot of revenues, and now it has completely reversed that and then some. So at least according to the market, the main conflict is over. You're seeing that in oil prices. More on that later. And yes, could reverse, but it looks to me, especially with the down volume, that people are saying I need to commit capital elsewhere, and the new administration defense buildup trade is over, at least for now. And I'll let you know if I do see a reversal, but this looks pretty definitive of a breakdown to me, and you see that in the individual components. So, as far right now, the war is over in terms of the market, and let's go find some other things to buy.
And do you see it in other components? I mean, other than the defense ones?
Okay, let me go to
I don't
my.
mean components of the ETF. I mean just other market parts of the
Well,
other
no, here
parts.
we go. I mean, this is the XLE, which I was going to talk about, and this isn't as bad, but this is Exxon and Chevron and ConocoPhillips, and it's pulled back as oil has, and again, the down volume is being more pronounced than the up volume, and I talked about this on Tuesday, and I talked about it right when the war broke out, that the the uh, the energy, the oil and gas trade is too obvious, too extended, and too late for you to participate in, and that has certainly worked for the E&P exploration and production players, and for the service players. You put those two together, it's been a push, and you've made no money, and so now, and this is a decent segue. What I bought back in January 15th and 28th at an average price of 94. Here it is at 123, up 35%, 36%. I didn't look this morning, but this is the State Street Spider S&P Oil and Gas Equipment and Services ETF. And so between Venezuela and uh, uh, and Iran, you are going to have a lot of rebuilding of oil and gas wells and pipelines and what have you. And so the seismic companies, the frackers, the drillers, they all look very, very good. And the people that pay them, the Conocos and the Exxons, do not. I also have to believe that President Trump has called the components of the XLE and said, put your capital discipline away at least a little bit, and drill, baby, drill, and produce, baby, produce, so that we can have gas prices down for November. And so the oil equipment services names look good. The oil producers do not, and the defense makers do not. So it just suggests that the bulk of the Iran conflict is over, and start getting bullish on other things, in my opinion.
Yeah, it's interesting. It's one of the interesting CNQ that Bob Morris talks about too, has like a 4% yield at the current price, even with a 10% pulled back. What's interesting to me about that one is that he's explained that historically they give special dividends and they raise the dividend pretty aggressively when there are spikes in oil. So you're facing a stock that most likely is going to pull back if peace continues to break out, as they say. Um, and but you have a dividend yield that really supports a price, as he says, anything like $60 a barrel is still great for them, let alone 100. So it's an interesting one. Hi, I'm David Maris. If you like what you just heard, we've tracked every single pick we make on the show, every ticker, every thesis, every entry price, over 1,100 picks and counting. We put it together in a free report with our top 10 performers, the reasoning behind each one, and a preview of our full dashboard. If you want access, the link is in the description.